Let's get to South Africa's central bank, which today raised its repo rate by 75 basis points to 6.25%, in line with expectations, even as the country's headline inflation came in softer at 6.6% on Wednesday. Here is an excerpt of the Post-Monetary Policy Committee meeting press briefing held a few hours ago by the governor, Lesetja Kgyago.
The bank's forecast of headline inflation for this year is unchanged at 6.5%. For 2023, headline inflation is revised lower to 5.3% as a result of lower food, fuel, and core inflation forecasts. Headline inflation of 4.6% is expected in 2024. Our forecast for core inflation is unchanged at 4.3% in 2022 and lower than previously expected at 5.4% in 2023. The forecast for 2024 is slightly lower at 4.8%. Services price inflation is broadly unchanged. Core goods price inflation, however, is forecast lower in each of the 3 years, largely due to a lower starting point for vehicles and non-alcoholic beverages inflation. Average salaries are forecast to rise by less than expected at the time of the July meeting, at 5.1% in 2022, 6.7% in 2023, and 5.6% in 2024. The risks to the inflation outlook are assessed to the upside. While producer price and food inflation has eased, Russia's war in the Ukraine continues, with adverse effects on global prices. Oil prices increased strongly from the start of the war to around $130 per barrel and may rise again from today's levels as stresses in the energy markets intensify. Electricity and other administered prices continue to present clear medium-term risks. Given below inflation assumptions for public sector wage growth and high petrol and food price inflation, considerable risk still attaches to the forecast for average salaries. Higher than expected inflation has pushed major central banks to accelerate the normalization of policy rates, tightening global financial conditions, and raising the risk profiles of economies needing foreign capital. G3 interest rate levels for the forecast period are now expected to be somewhat higher than in July. On balance, and with few exceptions, capital flows and market volatility will be elevated for emerging market assets and currencies. The rand depreciated by about 3% to the US dollar since the July meeting. An additional tightening of global conditions will present further risks to the currency. The risks to inflation identified over the past year have been realized, pushing up South Africa's headline inflation rate and inflation expectations. Average surveyed expectations of future inflation have increased to 6.5% for 2022 and 5.9% for 2023. Expectations for inflation based on market surveys have increased to 6.7%. Long-term inflation expectations derived from the break-even rates in the bond market have moderated slightly to about 7%. The second quarter of this year saw headline inflation breaching the target range and is expected to remain above it until the second quarter of 2023. By the fourth quarter of 2024, we expect headline inflation to revert to the midpoint of the target range on the back of declining fuel and food inflation. The forecast takes into account the policy rate trajectory indicated by the bank's quarterly projection model. As usual, the repo rate projection from the QPM remains a broad policy guide, changing from meeting to meeting in response to new data and risks. Against this backdrop, the MPC decided to increase the repurchase rate by 75 basis points to 6.25% per year with effect from the 23rd of September 2022. 3 members of the committee preferred the announced increase. 2 members preferred a 100 basis points increase. The level of the repurchase rate is now closer to the levels prevailing before the start of the pandemic. The revised repurchase rate path remains supportive of credit demand in the near term while raising rates to levels more consistent with the current view of inflation risks. The aim of policy is to anchor inflation expectations more firmly around the midpoint of the target band and to increase confidence of hitting the inflation target in 2024. Guiding inflation back towards the midpoint of the target band can reduce the economic costs of high inflation and enable lower interest rates in the future. Achieving a prudent public debt level, increasing the supply of energy, moderating administered price inflation, and keeping wage growth in line with productivity gains would enhance the effectiveness of monetary policy and its transmission to the broader economy. Economic and financial conditions are expected to remain more volatile for the foreseeable future. In this uncertain environment, monetary policy decisions will continue to be data-dependent and sensitive to the balance of risks to the outlook. The MPC will seek to look through temporary price shocks and focus on potential second-round effects and the risk of de-anchoring inflation expectations. The bank will continue to more closely monitor funding markets for stress. Rate adjustments take place in the context of economic conditions. We have got a price stability mandate, and that is what drives policy. We look at all the other indicators, including what is happening to growth relative to potential, because that tells us the extent of slack in the economy. We also look at other indicators that would impact on the South African economy that could be from the global side. Rates are in response to economic conditions. You asking at what stage do we look at indicators that would tell us that rate hikes are detrimental to the economy. What we do know, what is detrimental to the economy at the moment, is the rising cost of living, which is depicted through inflation. And that failure to deal with inflation now would be detrimental to the economy down the line. And that is what our focus is. I was in Jackson Hole. I do not remember this thing that you are referring to of a commitment to increase rates over the next 2 years. But what we do know is that central banks take their decision from meeting to meeting, depending on changing economic conditions, and recalibrate policy accordingly. I do not think that it would be wise to say we commit that this is what is going to happen, because we do not have a crystal ball that is going to tell us what is going to happen 2 years down the line. As it is, it's difficult to say what is going to happen between now and the November meeting.